Welcome to today's discussion. We're diving into a fascinating argument about investment strategies, specifically the Bogleheads approach, and its claim to be game theory optimal. It's a bold statement, isn't it?
Indeed. The assertion that a passive, low-cost index fund strategy is game theoretically challenges the very foundation of active investing.
Exactly. Many believe active management, with its attempts to beat the market, is the way to go. But this paper suggests otherwise. What's the core argument?
The core argument hinges on the concept of Nash equilibrium within the context of efficient markets. If markets are efficient, consistently outperforming the market R, generating alpha to you becomes extremely difficult.
So, in essence, the Bogleheads method is a response to market efficiency. Let's unpack this game theory concept. How does it apply to investing?
Game theory analyzes strategic interactions. In investing, it's about how investors' actions influence each other and the overall market outcome. A Nash equilibrium is reached when no investor can improve their outcome by unilaterally changing their strategy given the strategies of others.
So if everyone is using a passive strategy, no one can gain an advantage by switching to an active one.
Precisely. In an efficient market, active strategies, while potentially offering higher absolute returns, often come with higher risk, negating any advantage in risk-adjusted returns.
The efficient market hypothesis is central to this argument. Can you elaborate?
The efficient market hypothesis posits that asset prices fully reflect all available information. This makes it incredibly challenging to consistently generate alpha, that extra return above the market average.
So if the market is efficient, trying to beat it is a losing game in the long run.
Statistically, yes. While short-term market fluctuations exist, long-term returns tend to revert to the mean, reflecting the intrinsic value of assets. This is why the weighing machine aspect of Benjamin Grant's quote is so important.
What about factor investing? Strategies like tilting toward small cap stocks.
Factor investing attempts to exploit market inefficiencies by focusing on specific factors like size, value, or momentum. However, these premiums are not free lunches. They come with increased risk, and as more investors adopt these strategies, the premiums diminish due to crowding.
So the supposed advantages of factor investing are eroded by its own success?
Exactly. The market quickly adjusts to these strategies, reducing their effectiveness. Studies by Fama and French support this, showing that market beta, overall market movement, accounts for the lion's share of returns.
How do passive strategies like those advocated by the Bogleheads fare in this context?
Passive strategies, such as low-cost index funds and ETFs, offer market average returns at minimal cost. They avoid the risks and expenses associated with active management, maximizing risk-adjusted returns.
So they're essentially a low risk, low cost way to capture market returns?
Yes, they provide a stable, diversified exposure to the market without the need to predict market movements or identify undervalued assets.
But real-world markets aren't perfectly efficient. There's imperfect information and market dynamics.
You're right. Imperfect information, varying investor preferences, and market shocks create inefficiencies. However, these are often short-lived. Active investors play a role in price discovery, but their success is not guaranteed.
So even with inefficiencies, the long-term trend still favors passive strategies.
Yes. While active investors may temporarily exploit inefficiencies, the overall trend towards market efficiency favors passive strategies in the long run.
Let's talk about the fees associated with active management.
Active management often involves high fees, which significantly eat into returns. These fees often outweigh any potential alpha generated, leaving investors with less than they would have earned with a passive strategy.
So the fees often negate any potential outperformance?
Often, yes. Unless an active manager consistently and significantly outperforms the market, the fees erode the benefits. And remember, consistent outperformance is exceptionally difficult in an efficient market.
But don't active investors play a crucial role in price discovery?
They do. Active investors help to identify and correct mispricings, contributing to market efficiency. However, their actions ultimately benefit passive investors who capture the market's average return without bearing the risks and costs of active management.
So active investors inadvertently help to create a more efficient market that benefits passive investors?
Precisely. Their efforts contribute to a Nash equilibrium where both active and passive strategies coexist, but passive strategies become increasingly dominant as market efficiency increases.
Can you elaborate on the Nash equilibrium in this context?
In this context, a Nash equilibrium is a state where neither active nor passive investors can significantly improve their risk-adjusted returns by unilaterally changing their strategy. As market efficiency increases, the equilibrium shifts towards passive strategies.
So the more efficient the market, the less room there is for active managers to outperform.
Exactly. The competitive landscape becomes increasingly challenging for active managers, making passive strategies the more robust and reliable approach.
The paper uses the analogy of searching for a needle in a haystack. Can you explain that?
Active investors are searching for the needle, alpha, in the haystack, the market. Passive investors are simply buying the entire haystack, capturing the average return without the effort and risk of finding the needle.
A simple yet powerful analogy. The paper emphasizes the importance of a long-term perspective.
Absolutely. Short-term market fluctuations can be misleading. A long-term perspective allows investors to ride out market volatility and benefit from the power of compounding. Passive strategies are particularly well suited to this long-term approach.
So patience and discipline are key to success with a passive strategy.
Essential. Avoiding emotional reactions to short-term market movements is crucial for long-term success.
So in conclusion, the paper argues that the Bogleheads approach, with its emphasis on passive, low-cost index funds, represents a game theoretically optimal strategy in the context of efficient or near-efficient markets.
Yes, the argument is that in a market where risk is inherent and returns are not guaranteed, minimizing risk while capturing market returns is the dominant strategy. Passive ETFs achieve this through diversification and low costs.
And the inherent difficulty in consistently generating alpha in an efficient market further strengthen this argument. It seems the paper makes a compelling case for the long-term benefits of passive investing. The emphasis on minimizing risk and costs while capturing market returns resonates strongly.
Indeed. The Bogleheads approach offers a robust and reliable strategy, particularly in the context of increasingly efficient markets. The simplicity and low cost of passive investing make it an attractive option for many investors, especially those with a long-term horizon.
That was a great discussion. Thank you for your insights.